Welcome back. Let's straight away dive into our first conversation. And we're talking about all these positive global cues coming in. Matt Orton, Chief Market Strategist at Raymond James Investments, is with us now. Matt, good morning. Always a pleasure having you on the show. So what we have is a roaring, bull rally in global markets thanks to the U.S. inflation number, which didn't scare the market away. But what is your sense that, if the premise is that we'll probably get one at max 2 rate hikes in the U.S., is that well digested, and do you expect global equities to move higher?
Hey, Surabhi, great to see you as always. And I do. I'm expecting to see one more rate hike at a minimum in July. It was definitely welcome news to see a softer than expected inflation print. And it's clear that inflation is very much so moving in the right direction. I think there's a few nuances within the inflation print, specifically airline tickets being down very, very significantly, may have skewed a little bit of the data, but still, the news is there. I think we can't get too excited. The Fed still cannot declare that its mission is accomplished, because when you look at the labor market, when you look at wage growth, there are still challenges going forward. So, July is basically a done deal, in my opinion. Looking forward, I really do think we have to take the Fed at its word that it's going to be data dependent. Regardless of whether July is the last hike or whether you get one more hike after that, I think the main message I've been talking to clients about is that higher for longer is very much higher for longer. So even if it's one or two more rate hikes, rates are going to stay at these elevated levels, especially if economic data continues to be supported. But I think the rally in global markets makes sense. Valuations aren't that stretched overall. And, I guess the flip side of some of the narrow breadth that we have seen in the US in particular, but also globally as well, is that if the economy holds up better than we think, and maybe if central banks can take their foot off the brake just a little bit, that should give more support to the parts of the market that haven't participated as much. And so that's where I'm looking for opportunities, is where there's quality companies with solid fundamentals that have just been forgotten about because maybe they're not part of all of the AI enthusiasm. But it's an exciting time to be looking for opportunities selectively in the market.
Okay, we're going to take that point forward. Matt, good morning. It's an exciting time to be looking for opportunities, you say. In a market like India, where do you see opportunities lie? I mean, it's been a good market so far. We've rallied about 7% this year. But what next?
Yeah, hey, Sonia, always good to see you too. And I've been favorable on the Indian markets for some time, as it was a challenging start to the year. But I think within India, the areas that I continue to like and favor are the banks. Autos and auto components continue to look favorable. And within industrials, there's areas that are tied to infrastructure spending and also aerospace and defense. It's not just a theme in India, but it's a global theme, especially when you look at where we are with respect to geopolitics. I think you continue to see that play out. And what's exciting about India is it's a direct beneficiary from a lot of the supply chain problems that China inflicted on itself due to zero COVID. So you're seeing Apple starting to actually manufacture iPhones in India. You're starting to see more infrastructure being built out as supply chains move from China into India. And that's a multi-year process. And so I think both long-term, there's some really, really exciting opportunities. You look at Hindustan Aeronautics partnering with GE. Those are exciting deals. And I think that's just a signal of what is to come down the road. Given where we are technically, I would probably wait for some consolidation, whether it's through price or time. But if you get down closer to 19.3 on the Nifty, if there's a little bit of weakness in the Bank Nifty, those are good opportunities, I think, for investors to redeploy capital in good companies where you're seeing margins hold up and you're seeing positive earnings.
Okay, all right. Hi, Matt. Matt, you got the sectors that you're positive on, but what about the tech space? What's the view out there?
Yeah, Nigel, tech has been an area that I haven't loved for a while. I think one of the biggest challenges is just simply the weight of IT services within the overall index. And I think the IT services complex is challenged mostly just because of issues overseas as well. When you look at where some of their biggest clients are, banks, investment banks, asset managers in Europe and the US, even though it's been a great year for markets, AUM levels, margins for a lot of their clients aren't there yet. They haven't recovered. And I think it's going to take a couple more quarters for that to play out. So even though valuations are compelling, you haven't seen that big bounce off the bottom that one may have expected after some of the big earnings missed last quarter, like with Infosys and some of the weakness you've seen in other services. But I would think if you continue to see the bull market globally continue to move forward into Q3 and Q4, I think that's the opportunity to start looking to maybe pick up and get some good value within the IT services in India.
Got that, Matt. Thank you very much for joining us today in